Just to let you know, my name is Lee, and I'm the manager of member engagement and development here at Hospitality Newfoundland and Labrador. Good morning, and thank you for joining us today. Hospitality Newfoundland and Labrador is pleased to partner with Grant Thornton to offer this information session on business succession and acquisition. Grant Thornton LLP is a leading Canadian accounting and business advisory firm providing audit, tax, and advisory services locally and across Canada to dynamic privately owned, publicly listed, and public sector organizations. Before we get started, I want to respectfully acknowledge the province of Newfoundland and Labrador as the ancestral homelands of many diverse populations of Indigenous people who've contributed 9,000 years of history, including the Buyout on the island of Newfoundland. Today, this province is home to diverse populations of Indigenous and other people. We also acknowledge with respect the diverse histories and cultures of the Mi'kmaq, Innu, and Inuit. I am happy to introduce our presenter this morning. Laura Churchill is a senior manager at Grant Thornton LLP in the advisory service line. She obtained her Chartered Professional Accounting designation in February 2017 and her Charter Business Valuator designation in December 2020. Laura has over 8 years of experience with a broad range of clients providing business valuation services, transaction support, business plans, projections, and other general business advisory services. So welcome to Laura. And just to let you know, there will be an opportunity for Q&A following the presentation. We ask that you just type your questions in the Q&A box there, and Laura will be only too happy to help answer your question. Also, this session will be recorded and uploaded to H&L's YouTube channel following the presentation. So now I'll hand it over to Laura to get started.
Perfect. Thanks, Linda. I'm just going to share my screen here now. Okay. Can everyone see this? I think, Linda, we should be good, are we?
We're good.
Perfect. All right. So good morning, everyone. Like Linda mentioned, I'm Laura Churchill. I'm a senior manager here at Grant Thornton. I'm physically located in St. John's, but I do service clients all across the province and in Labrador as well. And I focus mainly on valuations and transactions, but I do some financial forecasts, business plans, and a variety of advisory services as well. So I guess for the agenda today, what I wanted to touch on was succession planning, including types of exit strategies, business valuations, and capital gains. I will mention that I am not a tax specialist, so the capital gains section is going to be a little bit brief, but I really just wanted to get that main point across because it is an important piece for succession planning. And then at the end, I'm going to focus a little bit on buying a business, so financial forecast and the process overall and the due diligence. Okay. So why is the succession plan important? It's important for a number of reasons. So to understand the goals of the shareholder, both short-term and long-term, as well as other family members. It's important for tax planning purposes. So to ensure that when you do eventually sell your business or transfer it to the next generation, that you're really maximizing your after-tax proceeds and minimizing the taxes on an eventual sale. Understanding the business value now and what drives the value in the future. So taking the time to understand what truly drives the value of your business can really allow you to plan and grow that for an eventual sale. It's important to help you identify options for transition and understanding who the most likely buyer may be. And it's important to develop a strategy to implement your succession plan. So as an example, what does that timeline to an eventual transition look like? Do you want to just turn over the keys one day and walk away, or would you prefer a slower transition where you introduce a new owner over time? So I do have a poll here. I think this is going to come up on the screen shortly, but I think everyone can respond to this and this should pop up. So it's, have you thought about your succession plan? The response options are yes, I have a transition plan to retire in the near future. No, I've given it some thought, but I don't have a plan in place. I'm not ready to retire yet, or I'm focusing on acquisitions and growing my business instead. And I believe this should come up on the screen, Linda. Oh, I do see it from my end here now.
Yeah, the results are up there, Laura.
Perfect. Okay. So this is interesting and kind of what I had expected. The majority, so 43%, have said, I thought about it, but I haven't put a plan in place. So that's interesting. What I can say is we have definitely seen in the past, we've chatted with clients about succession plans, and it's always something that business owners have given some thought to, but they've kind of said, well, I'm not ready to retire yet, so maybe I'll just worry about that in a few years' time. What I will say is the past few years have been unexpected and uncertain for everyone. So we are seeing a number of people kind of take a step back and say, maybe I should kind of think about this and put a plan in place. So I guess the next thing I'm going to touch on here is some potential exit strategies. So I guess one thing, like in Newfoundland in general, in the past, we've often seen businesses transferring to the next generation. So either to the children or other family members, such as nieces and nephews. We are seeing kind of a trend away from that. And I think that just comes down to the fact that years ago, it was just kind of expected that the children would kind of take on that business. But the reality is not everyone wants to do that. There are some recent tax changes actually that do make the transfer to the next generation easier now and more tax efficient. So it may be a good time if you're thinking about that to kind of say, okay, maybe we should look at this and how we can transfer it to our children. In other cases, an exit strategy may be to an employee or a management buyout. So a lot of the times when I talk to clients, we'll often hear them say, well, we do have employees or management team members who would be a great fit to take on the business, but they don't have the funds to do that. They would never be interested in buying the business or taking it over. What we actually find interesting is a lot of the banks will actually finance the purchase of a business, provided that there are good cash flows, there's a good management team in place, and they can see that the future cash flows in the business can truly fund those debt payments. That is what we're seeing a lot of clients do, and we have been able to help clients kind of work through that process even when they didn't think it was a good fit. And of course, the third option here is a sale to a third party. So in some cases, that could be a competitor. It could be a larger company in the industry. We do see consolidations in some industries, or an entrepreneur who expresses interest. When it comes to selling, this could be a personal decision or it could be based on market factors. So maybe you want to step away because you're ready to retire, or you just want to take more time to spend with your family or travel around the world, provided that we're finally getting back to that. And it doesn't mean that you have to sell 100%. So maybe what you want to do is retain an ownership percentage, but you would like to step back a little bit and kind of transition someone on your management team or an employee who's going to eventually fully take over that business. When it comes to market factors, this is something that I guess is really important from a succession planning perspective. A lot of the times when we talk with clients, they say, well, I'm not ready to sell yet. I'll think about that when the time comes. But the reality is when I step back and ask a lot of clients, would you sell if someone were to offer you the right price? The answer is most often yes. So, as an example, we've seen a recent trend, and this is just, we've seen it in the vet industry, but it does happen in a number of industries at certain times where we see a lot of consolidation. So, I'm just going to share a little bit of an example here. I was working with a couple clients in Atlantic Canada who were in the vet industry. They own vet clinics, and they said, I think I kind of want to sell. One of them actually said they wanted to sell. The other one were much younger. They were not interested in retiring. It wasn't even a consideration. So, throughout the process of helping this one vet who was ready to retire sell, when the offers started coming in, the price that the consolidation companies, so the national vet companies out there that were acquiring a number of smaller clinics, the price that they were willing to pay was well more than what I would have expected when I sat down and looked at the value of this business. The reality is that these consolidators were coming in and they were trying to purchase a number of clinics, and they were really competing for the most that they could get. Um, and when we saw those offers come in, we said, wait a minute, maybe there's other clients that would want to take advantage of this. So we sat down with a business owner who was nowhere near ready to retire, and we said, if you were able to get a significant price for your business, would you be willing to sell? And they said, well, they hadn't really thought about it, but for the right price, and given that this was truly a market opportunity that may not exist in 2 or 3 or 5 or 10 years' time, they did want to take advantage of that. So we went through a process, and they were actually able to sell 75% of their business for a significant amount. They were able to retain 25% ownership and continue operating the business as if they had before. They just had a new shareholder on the table. So that's just one example of how sometimes the opportunity might arise, and it might be a market factor that really sets you into wanting to sell your business. Um, and if you don't have a succession plan in place, it may not work out to be the most tax efficient route to go. So if you have a plan in place and you know your business is structured effectively, if something like this were to arise, it can help you maximize your proceeds and minimize taxes. So the next thing I wanted to touch on is just how to maximize price. So there are a number of factors that are really important and a buyer would consider looking at. I'm not going to go in detail on all of these, but obviously, strong cash flows, strong income coming to the business is going to be important to a buyer, or alternatively, a strong balance sheet where you have a number of assets that you're willing to sell. So I'm going to touch on this a little later, but basically every valuation is either done on a cash flow or an asset based. So understanding what truly drives that value and understanding what's important to a buyer can help you maximize the price. Strong management team is another thing that comes to mind. So, as an example, if someone were to come in and buy your business, and the reality is that you're there every day, you're doing the day to day operations, and if you were to walk away, there might not be someone there to kind of pick up your role. So having a strong management team and just knowing that if you were to take a vacation, the business would run as normal, that helps maximize value as well. Customer base. This is a big one as well. So if you have a broad customer base rather than just one significant customer, of course, this increases value because at the end of the day, if you do just have one customer and they were to walk away tomorrow, then you're really left to start to grow that customer base again. And of course, products and services and your labor force, just having something that you can kind of differentiate your business from others in the area is always great to maximize price and value as well. So I do have another poll here that's going to come up on the screen. So for those of you who have thought about your succession plan, what do you think is your most likely exit strategy? So the response options are, I have children or relatives who may want to take over, a transition to a manager or employee, a sale to a third party, or I plan to close my business. And I believe the responses come through here anonymously anyway, so I did just want to point that out. I know it's not something that business owners often want to share publicly. Okay, interesting. So the responses are in. 67% have actually said a sale to a third party. The two lowest are I have children or relatives who may want to take over, and I plan to close my business. So that's interesting because I know a number of years ago it was often just assumed that the kids would take over the business and want to continue that, but a sale to a third party, that's interesting and again kind of what I would have expected. So I guess before I get into the next point here, I did just kind of want to share one story on this point as well. So the reason I had included I plan to close my business is because recently we had worked with a client who had come to us and they had said, I'm ready to retire. I think at the end of this year, I'm just going to close my business. Can you help me with that? And we took a step back and we sat down with that client and we said, well, why do you want to close the doors? Why do you just want to walk away from everything that you have grown over the past number of years and really just let that all go away? And he said, well, there's no one that I really think would want to take it over. I don't have any children. It's maybe in a rural area where we didn't think or he didn't think there was a third party that would be interested in buying his business. And he didn't think any of his employees would want to take over or have the means to buy into the business. So we took a step back and we said, well, why don't you just look at it and see what it could be worth? So we went through a process with that client to look at the value of the business. And at the end of the day, when we went through that process, we actually came to realize that he was leaving a fair bit of value on the table. And when he sat down with his employees, what we came to realize is that there was someone who was willing to buy and they were able to get financing to finance the acquisition rather than have him shut his doors and walk away. So that's just one example of why having a plan in place and understanding your value can really help um, maximize proceeds and really just help you continue on the legacy of your business rather than closing the doors. So, getting ready for succession planning, understanding value and price is definitely a good thing. And this doesn't mean understanding the value right before you're getting ready to sell. It could be a good process to go through ahead of time as you're kind of working through that plan. So, having a valuation or a pricing analysis of your business completed can really help you identify the discrete value in the business. So, it can really help you understand, is the value of my business driven by its cash flows, or is it really due to the assets or the buildings that I own? It can also help you identify any redundant assets in the business that you may want to extract prior to a sale. So, as an example, it's not uncommon for business owners to have vehicles in the business that may be used personally and for business purposes, or maybe there's something in there that is really not essential to the operations that they would like to keep prior to selling. So, going through that process can really help you identify those assets and find a way to pull them out of your business tax efficiently prior to a sale. It can also help you assess if the business is ready for a sale and ensure that it's in line with the shareholders' expectations. So, one example here, I actually went through this process with a client a while back who was interested in selling their business. And when we sat down and looked at it, they had acquired the business fairly recently. It was a rental business, so they had cabins or chalets or something where they were looking at selling. And when we took a step back, we looked at it and we said, listen, your business has been growing. I think you're doing really well. If you were to sell right now, you could walk away and have a decent amount for the business. But if you were to hang on for a few years, we think you could get a lot more. So that's definitely a decision for that owner that depends on their personal circumstances, but it can really help you understand if the time is right. And maybe it is, maybe you're willing to walk away now, or maybe you want to hang on for a few years and continue to grow that. It can also help you understand how a purchaser is likely to price the business. So just understanding where the value comes from can help you understand if someone were to come in and buy that, what types of things they're going to want to look at. It can also help you work through the process with a tax specialist and propose the most efficient tax structure. So I'm going to touch on this a little later, but depending on how your business is structured, it can actually help you maximize proceeds and minimize tax on an eventual sale. What I will say here is that anytime I do a valuation report for a client, I always recommend that they keep that to themselves. I do not recommend that you hand this over to an interested buyer. The reality here is that a number of buyers may be willing to pay more for your business depending on a number of circumstances. So, as an example, it could be a business owner in the area who is not, I guess it could be a competitor who is looking at purchasing your business to kind of grow theirs. Or, as an example, it could be a business owner who is currently on the east coast of the province and they want to buy a similar business on the west coast. So, there could be motivating factors there that might motivate them to pay a higher price. So, that's why I never recommend handing over that valuation report to an interested party. Really, the goal of the process is really to target the right purchaser who may be willing to pay a greater price than fair value for their own reasons. Okay, so I'm just going to touch on some key concepts here as well when it comes to valuations. Um, First of all, every valuation report is done at a point in time. So anytime a valuation is done, it is completed as of a specific date, and that value can change over time. The reality is if the business kind of continues as status quo, the balance sheets and the assets don't change, the cash flow is fairly similar, then it may not be significant changes, but you do really want to understand, okay, when was this valuation completed? And maybe my business has grown since then. When it comes to valuing businesses at a point in time, hindsight can also not be used. So if we were valuing a business as of December 31st of 2021, and you obtained a new contract since then, unless you were to update your valuation date, you can't go in and factor in that contract because that would be using hindsight. So those are just kind of the things that you want to keep in mind when you're having a valuation completed. Value versus price. So I touched on this a second ago, but price may vary from value for a number of reasons. So one thing is special interest purchasers. So that's what I had mentioned. There may be someone who is interested in purchasing your business for a higher price due to the fact that you're a competitor or they want to expand into your region. Um, but there are a number of other factors as well. So consideration. When you're selling your business, someone may be willing to pay you all cash, or maybe it's a portion of cash up front and then some type of earnout. So that could be a reason for a difference as well. And timeline. So just do you want to sell at the time your valuation was completed or have 5 years passed since then? Also emotions and negotiating factors. So even though you may have a valuation completed for your business that says it's worth this on paper, the reality is that's a business that you've put a lot of time and effort into over a number of years. You may have an emotional attachment of that, and the reality might just be that you're not willing to sell for less than a certain price. And negotiating power as well. So everything at the end of the day comes down to negotiating factors, and that always plays a role in the price that's obtained. I had mentioned earlier that every valuation is done on either an income-based approach or an asset-based approach. So the difference here is really that when you're valuing a company on an income-based approach, the value of the business is really driven by its cash flows. So if you were to separate the assets, really what it comes down to is that the business is generating cash each day that is valuable to a buyer. When we go through that process, the cash flows are risk assessed and translated into a multiplier. So you'll often hear references to, oh, this business would sell for 4 or 5 times of Ebitda. And Ebitda is just earnings before interest, taxes, and depreciation. So it's really the net earnings of your company, excluding those couple of items. An asset-based approach, this is used either in the absence of positive cash flow or for holding companies where the value is truly attributable to the assets. So if you were to think about a rental property or a hotel or something where the value truly truly lies in the building that you own, that is a situation where we would look at an asset-based approach. And really what the buyer would be looking at purchasing there is the value of your building and the earnings that can be generated by that building. In some cases, it's not actually that cut and dry on whether it would be an asset-based or a cash flow based. So I guess one example that comes to mind, and this could fit a number of different scenarios, but just one example that comes to mind to me right away is a construction business. So there's oftentimes that we'll look at a construction business and yes, they're generating cash flows year over year, and a cash flow approach makes sense. The reality is they may have a lot of equipment on their books that have depreciated over the years for accounting purposes, but are actually still holding their value and worth a lot more. So in those cases, what we'll do is we'll look at the income-based approach and the asset-based approach and see which is higher. And that's really how that can vary. So going through that process can really help you understand what is truly driving the value of your business, even if it may seem like it should be cash flows, maybe it's the assets or vice versa. Okay. I did just want to touch on this example because I know this can be a point of confusion for a number of clients when they're going through the process of having a valuation done. And every transaction is structured differently. So oftentimes when businesses are sold, they could be sold on a cash-free and debt-free basis. So really, I just want to point out here the difference between the enterprise value or the value of the operations of your business and the equity value, so the value of the shares. And the key point here is really just to understand what it is that you're buying or selling. So as a simple example, I like to refer to just selling your house because I think it's the most relatable situation that would be similar to understand. So we often hear businesses selling for a multiple of Ebitda. So this is just an example. If you had a business that was generating $2,000 of earnings each year before taxes and depreciation and interest, and businesses in the industry were selling for multiples of about 4 times. What that means is that the enterprise value or the operations value of your business is about $8,000. But let's say that you have $3,000 of outstanding debt on the books. Really, what your net value is at the end of the day is the $5,000 after the debt is paid. So it's no different than if you had a house that you listed on the market for $300,000, but you still had $200,000 owing on your mortgage. Really, your equity value that you're left with at the end of the day is the $100,000 net of the mortgage. So there are a couple other situations aside from succession planning when a business valuation may be useful. I'm going to touch on this briefly, but I really just wanted to focus mainly on succession planning in this presentation. So they could be useful in shareholder transactions or disputes. So if you have two shareholders in your business and maybe one of them doesn't want to continue or you haven't been getting along, then it could be used as a point to kind of settle that and have one shareholder buy out the other. Corporate reorganization and tax planning is one. Financing, acquisitions or divestitures, regulatory compliance, a purchase price allocation. So if you went through a process to buy a business and you're wondering how that should be allocated on your financial statements, goodwill impairment testing, and fairness opinions. So a lot of these are more focused on financial reporting and other situations. So I'm not going to go into too much detail on this. But the other thing I just wanted to point out is that every valuation, really what it concludes on is the fair market value. And fair market value is defined as the highest price available in an open and unrestricted market between informed and prudent parties under no compulsion to act, acting at arm's length and expressed in terms of money or money's worth. So really this just goes back to the fact that the fair market value defined in your valuation is really meant to be the best price on the market when everyone involved has the same information, negotiating powers are not a factor, and everything is expressed in terms of cash consideration. So that's why some of those we often see that price could vary from value. All right, so capital gains. So I mentioned earlier, I am not a tax specialist by any means, but I did want to touch on this because it is definitely a very important factor when you're thinking about succession planning. So there is a lifetime capital gains exemption that any individual who owns a business, or any individual in general really, has access to. But it can be used in the sale of a business if it qualifies as a small business corporation. So there are a number of factors, and this is very much a tax planning exercise to kind of understand whether or not you qualify as a small business corporation. But high level, what that means is that you're a small business that's controlled by a Canadian. Most of your assets, so I think the general rule is about 90% of the fair market value of your assets is used in an active business carried on primarily in Canada. And at least 50% of those assets must have been used for active business for the past 24 months. And you must have held those shares for the past 24 months. So this is really a key point. There is a way to go through a tax planning process and understand whether or not you qualify as a qualified small business corporation and would have the lifetime capital gains exemption available to you on a sale. But that does have to be in place for a minimum of 2 years. So that's just why it's important to have that plan in place, because oftentimes we'll see business owners come in where they have an opportunity to sell, and maybe they don't have the lifetime capital gains exemption available to them as they don't qualify, but they don't want to wait 2 years and miss out on that sale. So the reason this is so important is I'm just going to show a brief example here, but let's just say that someone offers you $2 million for your business. And it's a business that you purchased, say, 10 years ago for $1 million. So you really put the time into that and you've grown it by about $1 million. That $1 million is a capital gain to you, which you would be taxed on the eventual sale of your shares. The lifetime capital gains exemption, the amount varies year over year, but right now I believe it's approximately $900,000. And what that means is that that portion of your gain is actually tax-free. So you'll see in the first scenario here, we have a capital gain of $1 million, and then we deduct the lifetime capital gains exemption. Really what we're left with is $107,000 of a capital gain that is taxable, and 50% of that is taxed. The tax rate here, I've assumed 35%, but the reality is that can vary depending on your individual circumstances. But what you're left with is tax on that sale of a business worth about $2 million of $18,000 in tax. If we are to look at that in the other situation, assuming that no lifetime capital gains exemption applies, what happens is you're actually taxed on 50% of the full gain of $1 million, and it increased taxes to $175,000. So you can see from that that there is quite a difference. And that's just one reason why it's important to think about these things. I will also mention that there are a number of ways that this can be structured. So the lifetime capital gains exemption is available to each individual, but there are ways that if there are multiple shareholders, the shareholders can use it twice. There are also ways to structure your business so that if other family members, so a spouse or children, if they want to let you use their lifetime capital gains exemption, there's ways to set it up so that you can use more than one. So that's the main things for succession planning and selling your business. I did just want to touch on buying a business a little bit, and this is really just going to be an overview of the process and things to kind of keep in mind. So first of all, financing and business plans. Anytime you're looking at buying a business, financing could be a key factor. So like we talked about earlier, if you're looking at a management buyout, so buying into a business that you're currently an employee in. Oftentimes the banks, depending on the situation, the banks or the financial institution may want to see different items. So at a minimum, it would be very helpful to be able to demonstrate the financial forecast and the projections for the company going forward to kind of demonstrate that you can repay that loan. In some cases, a business plan may be important as well. So it's not always required. In a lot of cases where it's a business that's been operating and has a great track record, it may not be necessary. But if it's a situation of a startup, an expansion, or if it's a situation where a business is really growing through acquisitions, a business plan could be important as well. And what a business plan will often include is that financial forecast that you would look at anyways. So it would include the financial forecast for the company going forward to kind of demonstrate to the bank that you could repay that debt. But it would also include a number of other factors about the future plans for the business, such as products and services, the market, competitors, and the management team. So the process overall for selling your business can be a lengthy process, and making sure that you have people involved to kind of help you on along the way can really help make that a little more stress-free. But the reality is that it is a lengthy process, and there are key things that you kind of want to pay attention to throughout. So, in general, every process to sell your business kind of starts with an offer. So, someone would come in and say, we're willing to buy your business. Here's our offer. And oftentimes that's expressed on paper as a letter of intent. So, in order to determine that offer, they may want to review certain financial information and key documentation. One recommendation I do have here is anytime you're looking at selling your business and you're going to, or buying a business and you're going to review financial information, you want to make sure that there's non disclosures in place. So if you were looking at buying a business and someone asked you to sign a non disclosure agreement, really all that is protecting their information. It's really meant so that you can't look at their information, decide not to go ahead and buy that, and then share that with their competitors. Or maybe you are a competitor. Once the price is determined through negotiation, due diligence is a key piece as well. So, due diligence is really the process of understanding that what you're buying is what you thought you're buying. So, this can vary and it really comes down to comfort level when you're purchasing a business. But different types of things to consider are financial, tax, operational, and legal due diligence. So, maybe you reviewed financial statements and you thought you had a great understanding of the financials of the business before you were willing to purchase it. But this is actually going through the process similar to an audit to understand that what's in those financial statements is actually legitimate. From a tax perspective, for due diligence, you really just want to understand that by purchasing this business, you're not inheriting any tax liabilities that could be a significant obligation to you down the road. So anytime you buy the shares of a company, really you're in the tax risks and tax liabilities sit with that company. So you're inheriting that risk going forward. So it's just important to understand that you are buying what you thought you were and that you really understand the risks and everything involved with that. The other thing that I always like to point out is understanding financial information. I mean, not all business owners are accountants, and understanding your financial information is very important whether you're looking at buying or selling. So, just being able to look at key ratios on your financial statements, understand your cash flows throughout the year before your financial statements are done at year end can really help you plan and really just understand what your business is worth going forward. So I know a lot of business owners are not accountants, and I think what happens is sometimes they tend to avoid these things, but just taking the time to invest and understand your financials can really be a beneficial tool moving forward. So that was everything that I wanted to touch on. I said we were going to be about 45 minutes, and I think that was pretty close. So I do have some time left if there are any questions in the chat.
Thank you, Laura. We do have one question in the chat,
Yeah,
and this individual just informed me that they've had to leave, but I'll pose the question anyway, and she's probably going to reach out to you, Laura, for additional
sure.
information. So here's the question. I'd like to know where to find consolidator or buyers without disturbing the staff and business, i.e. keep it confidential until ready to go public.
That is a very good point. And honestly, that is something that we are very mindful of. I mean, the reality is in Newfoundland, if you want to say that your business is for sale on a confidential basis, once you say your location and your industry, it's probably quite possible that someone could figure out what business it is that you're referring to. So that is something to keep in mind. And what we've kind of tried to do here, just on a confidential basis, is anytime any of our clients or anyone comes to us and say, "Well, we're looking at selling," we have a confidential list where we kind of keep that in mind. It's only us that see it. But what we kind of do is if then a buyer comes in and they might say, I'm interested in any acquisitions in this industry. If I'm looking at that and I've said, okay, there's someone interested in buying a business in this industry, and we know that this person is interested in selling, we can kind of have conversations with both people before introducing them. And that really just kind of ensures that you're not opening up that discussion until you know it could potentially be a good fit. The other thing I will say on that point is there are ways that you can kind of market your business on a confidential basis, but you just have to be very careful when it comes to showing the information because, like I said, once you say location and industry in rural Newfoundland, it can be really easy to figure that out. So in some situations, we've actually helped clients pull together a bit of a teaser document which says, okay, there's a business for sale in this industry. We might not say where it's located. It can be as simple as in Newfoundland, or we might even say in Atlantic Canada. And then it might help you generate some interest without giving away too much information and having to worry about your employees getting wind of that and kind of thinking, oh no, am I not going to have a job? Should I leave? Or having rumors circulate around the town or the province.
Okay, thanks for that, Laura. Okay, let me see. I don't see any more questions in the Q&A, but there's a couple here in the chat box. One
Yep.
individual wanted to know about the slides, and just so you know, the whole presentation will be up on our YouTube channel, so you can check it out there. Also, another question here. If you are a potential buyer, what is the best way to identify potential sellers?
That's a good point as well. So, potential sellers, I mean, I think one thing out there is, like I mentioned, just talking to people in the industry who work with clients and saying, I'm interested, whether that's your banker, your lawyer, your accountant, anything, but just saying, I'm interested in buying a business in this industry. And then it's really just kind of getting that out there on a confidential basis so that if the opportunity were to arise, someone will bring that to you.
Perfect. Okay, another question here. How is the multiple determined for Ebitda?
So EBITDA is actually the earnings on your financial statements before interest, taxes, and depreciation. So all that is net income, and then you would add back your tax expense, your depreciation on your assets, and any interest on long-term debt. So that's where EBITDA comes from. When it comes to the multiple, that is a tough one. And the reality is that it varies by industry, it varies by a number of factors. Really, what it's driven by is a risk assessment. So, anytime we do evaluation, there's a risk assessment that's done in the background that kind of works out to be that multiple. But what we often find is that business owners and in transactions in general, people just find it easy to look at the multiple that it's selling for. So that's a tough question, really. But the reality is there's some research out there that can be done by industry to help you come up with that, but it's not always that cut and dry to just say in this industry the multiple is 4 or 5 times. As a general rule, we do often see somewhere in the range of 3 to 5, but that is not always the case. And in the example of consolidation, so the example that I gave on the vet clinic, it was much higher than that. So it's a tough one, but having conversations and kind of understanding what other businesses may have sold for in that industry can maybe help you determine that multiple.
Perfect. Thank you, Laura. Okay, another question. Does marriage breakdown, buyout by one partner have the same capital gains implications?
That one, I think that can vary depending on the situation itself. And I think that would be more of a question for tech. So if you want, Linda, you can send that one along to me in an email and I can touch base with one of our tax colleagues and maybe I can get back with a better response on that.
Perfect. Okay, if the person who's asking that question, you can probably reach out to us at H&L as well, and we'll get some follow up on that for you. And I see one more
Definitely.
question here, Laura. What would be the cost to get a business valuation completed?
So it varies, and it really depends on the business, what's involved. I will say that it it can range. Like there's also different levels of valuations. There are funding programs out there though that would cover fees to have a business valuation done as well. Honestly, it can range. It can be anywhere from 6 to 10 to 12,000. It really depends on the business and the level of work involved.
Okay, it looks like that's all of the questions that I see in the chat and in the Q&A, Laura. Um,
Perfect.
so that kind of concludes our session. Thank you so much, Laura,
No
for
problem.
presenting for us today. Thank you to the Hospitality Newfoundland and Labrador team for organizing the event. We are going to be sending out a short survey looking for your feedback on today's session. So we appreciate that. And also, as I indicated earlier, reach out to any of us on the Hospitality Newfoundland and Labrador team if you'd like further information on what was discussed this morning. And that concludes our session. We appreciate you joining us. Goodbye, everybody, and have a great day. Stay safe, everyone.
Thanks, everyone.
Bye, Laura.
Bye.